Hey, brothers, how you doing? Welcome to another episode of Old Gold Table Talk. I am Brother Terrence Hawkins. I am going to be your host again and presented this afternoon. We have an awesome show for you. I'm telling you now, you will want to go ahead and invite as many brothers that you can to watch this episode. We are going to be covering taxes and the three things people are doing wrong. Again, we're going to be covering taxes and the three things that people are doing wrong, all here on Old Gold Table Talk. Come right back at me. We're coming back. All right, guys. Welcome again to Old Gold Table Talk, guys. With Terrence Hawkins, Brother Terrence Hawkins, guys, going to be coming to you and to cover this topic of taxes and the three things that people are doing wrong. Again, the three things that people are doing wrong. During this presentation, you are going to be able to ask questions. To be able to ask your questions, if you're listening live, especially, you're going to be able to, in your comment field, to go ahead and ask those questions. I'll be able to cover those questions during the presentation. You can ask questions whether you're watching on the Facebook platform or on the YouTube platform. So make sure that you put those questions in there, and I'll try to do my best to answer those questions. I hope this is a presentation that you may have a pen and a pad together. You may have a pen and pad, guys, because if some of these things that you do understand that you're handling on your taxes already to save your money, guys, you are going to want to be able to share that with somebody else. And one thing that I do remember is you may forget, but the paper never forgets. Okay. So let's write those down. This is our continued coverage, guys, on basically our financial series that we're doing. Last month, we actually talked about credit and how important that the credit was to each and every one of us. Well, this month we are going to be talking about the taxes and how important taxes is to each and every one of us. Number one, third of your income that you're earning, regardless of how you're earning your income, is going towards some form of taxes. And we really want to get into the discussion, guys, because if you've been following what's going on with the news and everything, taxes will go up. Okay, taxes will go up. I just want everybody to actually know that taxes is going to go up. So you want to make sure that you are minimizing your taxes. Now, a lot of individuals always talk about they want to minimize their taxes, they want to get it low and things of that nature, but they're doing it all wrong. They're doing it all wrong. And that's why we want to hit this subject, because we're at the end of the year and a lot of individuals are already thinking about what you got your tax season actually coming up next year to do those, want to know what kind of documents you need to get, what you need to get here, what you need to get there. And then some of you are probably thinking, hey, what do I need to do now at the end of the year to save me some money in 2021 that I can still do? And those are some of the questions I want you to actually ask, guys, and actually put there. But there's really three things that I really want to discuss this afternoon to actually help you out stuff and get you on the go. Because if you do not understand some of the things I'm actually going over, you're going to lose yourself a lot of money in taxes, okay? And we do not know that. Number one, the first thing that people are doing wrong is simply this. They do not know their tax bill. Write that down. You do not know your tax bill. Now, a lot of individuals already ask me, what in the world are you talking about your tax bill? What I'm talking about is this, guys. For you to reduce anything, you must know where you're starting. You have to know where you're starting at for you to reduce anything. If you are going to reduce your power bill, right, you're going to at least know what your power bill is. If you're going to reduce your cell phone bill, you're going to know what your cell phone bill is. Any type of bill that you have, you're going to at least know what the bill. When I ask individual then, what's your tax bill? People are confused. You do not understand how to reduce, okay, your taxes if you do not know where you start, if you do not know what you bill. So one of the things I want you to definitely look at when we're talking about your tax bill is another actual word for the tax bill that the IRS is actually going to tell you guys. It is called tax liability. Okay, your tax liability. That is the number one thing that you need to understand what it is, what's going on. So, what is your tax liability? It's simply, guys, your tax bill. I'm going to actually share it after screen real quick so you can see what I'm talking about. Here's what I'm going to actually share with you, actually, real quick, guys. Your tax bill, I'm trying to go bigger on this form so you can actually see what I'm talking about. It's on your second page of your tax form that's going to actually come up. It's on your second page of your tax form, guys. We'll look at over here, okay? And when you're seeing things over here, you're seeing your total tax, of course, and then you're seeing your, like your total tax right now with all the stuff actually that you have in there. But the one I want you to look at is saying tax, okay? Your tax, because this is basically going to be computed based off of your taxable income, which is on the other forms. Our forms look different this year. Taxable income, that's line 15. Write line 15 down. Line 15, your taxable income, okay? And then based on your taxable income, you're going to need to know line 16, which is your tax. That's your bill. Depending on how much income that you're making, you're going to be making a lot of different types of income that you have. That's on the first page right here of this form. You're going to have wages that you have. You're going to have dividends. You're going to have interest. You're going to have pensions. You got Social Security, capital gains. If you're in real estate and doing all those things in different businesses, you're going to have a total income. You're going to have a total income. And the whole goal, guys, of that is you got to basically look at that taxable income, because that goes directly into your tax rate to see how much tax that you owe based on that taxable income. Where the thing that people are doing wrong is they do not understand what their tax bill is or their true tax is, because they go from one year to the next year. See, I don't want you to go from your 2020 tax year and then you go into 2021 tax year and then you say, oh, I did better in my taxes this year. I did better. Well, the only way that you know that you do better is that you understand what that little thing right here called tax was in line 16. You need to compare apples and apples. What was your tax bill this year and your tax bill this week? Think about it for a second in the utilities again. If you had your utilities, and if you're looking at December one year and December the next year, you can compare those things pretty good to see, are you doing better this year or next year? You can compare July to December on some of the utilities because it's utilized differently. You may look at the total utilities one year and the total utilities the next year to get the total. You must compare those two things properly to understand. I want you to look at your last couple of years of your tax bill and see if that's going up and down. And you're going to compare that with your income that's going up and down. Here's what you look for. If your income is relatively the same, if it's relatively the same, and you see your tax bill go down, you're done a great job. You're done a great job. See, the problem that individuals, when they try to say, I want to reduce my tax bill, what can I do? Or I want to reduce the amount that I'm paying in taxes. They start to really think about just the refunds or how much they owe. That's not what you look at, because the Internal Revenue Service gives all these different credits and different things every single year, right? The different credits and how things work here, how things work there, and we're not seeing everything right. You want to make sure that you understand the bill. Most people do not know their bill. Any questions about that, guys? I definitely want you to make sure that you put it in the comments, okay? Put your questions in the comments, and I'll make sure that I answer those questions. But if we understand the bill and understand, like where we are and where we start is, then we can understand the next things that going on, okay? The next things going on that are what people are doing wrong on their taxes. What people are doing wrong on their taxes is simply this. Check this out. They are overpaying. They overpay during the year. They overpay during the year. Terrence, what in the world do you mean by I overpay during the year? I'm not overpaying my taxes a year. Yes, you are. Yes, you are. Internal Revenue Service basically actually said, okay, in a different way, that over 70% of individuals are overpaying on their taxes. They're overpaying. We live in what is called what is called a pay as you earn tax system. Pay as you earn. So as you earn income, you are paying the taxes. As you earn income, you're paying what? The taxes. Now, one thing about as you earn the income and you're paying the taxes is actually simple, actually this. When you are W-2 employee, you don't see it as that, but that pay as you earn is called your federal withholdings. That comes out of your check every time you get paid. That's pay as you earn. If you have a business, your pay as you earn system, guys, is nothing but your estimated tax payments. That's pay as you earn. Okay. Now, the goal is to even out during the year. That's the goal. You do not want the Internal Revenue Service to get too much money during the year than what is required. You do not want to do that. Why? Because you want to keep more of your money during the year. Again, the Internal Revenue Service said out of that 70%, the average overpayment is over $2,800 a year. $2,800 a year. So how can this tax return that we're looking at, okay, how can it basically show us what our pay as you earn is? Let's take a look at it. I'm gonna go to one page on this thing so we can kind of see it clearly and bigger. How does this thing go to the pay as you earn year? Here's how. Let's look at the number one line that people look at. The number one line that individuals look at, guys, is down here, line 35. Down here, line 35. Because they look at this thing called refund, right? They look at this thing called refund. But what they need to understand is what refund is. It shows you on line 34. It says this is the amount you overpaid. That's where we get overpayment for. You see, an overpayment is really your refund, or your refund is your overpayment. We have been conditioned to think that refund is something good. That's a mistake that people are doing. They think that refund is something good, but it's nothing but overpayment. If you overpaid on anything, you will be upset. So if you know your tax bill and know what your bill is supposed to do, then you can make sure that you are not overpaying, because then you can control, okay, that W-4 form or what comes out of your paycheck. If the average person is overpaying over $2,800, that's over $200 a month that the average person is overpaying on their tax bill. And they're getting the money back with no interest. You want to take that money and to put into the banks of yourself and earn interest on it yourself is what you want to do. So if you are one that has been getting these things called refunds, we want you to understand that you are really overpaying. Not get a refund, you are overpaying on your taxes. And a lot of times you're overpaying your taxes because you do not know your tax bill. Okay? You do not know your tax bill. So the first thing is understand what the bill is. And then the next thing, guys, is you can then figure out, okay, how much of my overpayment is going? How much of it is overpaying? Because the whole objective is to have, I'm going to go up to it. The whole objective is to go up to line 25, where it says federal income tax withheld. You want this amount to equal the bill. You want that amount to equal the bill. You want your job to take out the correct amount during the year of what you currently owe. That, guys, is nothing but just understanding the taxes itself. Again, it's hard for you to implement a strategy and know that the strategy works. You can implement a tax strategy. Don't get me wrong, because some of you may have implemented a tax strategy. But how do you know that it works? You don't know that it works unless you know your bill. Okay. And if you're still getting refunds, okay, the whole picture is not working because you're losing out on certain things still. So the first thing, okay, that we have to say again is people do not know their bill. The next thing is they overpay during the year. But the last one that I really want to actually go over also and show you some things on basically, what individuals are doing wrong on the taxes, guys, is they're focusing on the wrong tax strategies to reduce their taxes. They're focusing on the wrong tax strategies to reduce their taxes. I'm seeing this more and more every single year that people are doing. And how are they doing it, Terrence? Because, see, They listen to individuals, and there's different things to reduce your taxes. The first thing that you want to do to try to reduce your taxes is you want to attack the income. You want to attack the income because you want to attack the taxable income. That's the first thing you want to look at, on the tax strategies. If you want to look at the taxable income, that's what most people do, look at taxable income here, guys. They want that taxable income less. There's difference, guys, between income and taxable income. So anything that's at your job and stuff, and they say, hey, you get a tax deferred, or, like a whatever it is, or your taxable income, look at your pay stub. Start looking at your pay stub and then actually seeing what your gross income is, okay? And then taxable income. See, a lot of us see our gross income and then they go straight to net income, okay? Because you got a lot of things come out. The taxes are coming out, your federal, your state, your Social Security, Medicare is coming out. And then if you have any other types of, plans, like your insurance may be coming out, your retirement things actually may be coming out of there, right? All of those reduced to get net income. But I'm not talking about net income here. I'm talking about taxable income. It's to be on your pay stub. You have to understand the taxable income, because the tax strategy, guys, one of the tax strategies is to reduce the taxable income that you have. And you want to put a lot of things in place together. It's not just one thing, okay? It's not just one thing, but you want to put together things that affect the taxable income. You're making gross, but you're not getting taxed on the gross. You're getting taxed on the taxable. So you go to focus on there. And I said that's a big mistake. Why? Because of this line right here, that line number 12. This line right here, line number 12. Let me get that bigger for you. Line number 12 right here, standard deduction, itemized deductions. So many people are currently still trying to affect this deduction line. So many people are trying to affect this deduction line. And only 10% of America right now are itemizing their deductions and taxes. Only 10%. So for some of you, it may be good to continue on this. But most people try to do this, and they look at the different things that they think and they hear that's going to affect, and they focus on that, thinking that they're doing a tax strategy. One of the biggest ones right now, okay, I'm talking tax. I'm not talking about wealth. I'm talking about tax. But one of the biggest things right now is people say, hey, tax bill, you want to reduce it, get a house. Don't get me wrong, guys. I used to basically say that all of the time. I used to say that all of the time. Get a house, get a house, get a house, get a house, right? So I used to say, go get a house, go get a house, go get a house and stuff to reduce that taxable income. But since the laws actually change, okay, since the laws actually change, 10% of people are itemized. You see, getting a house goes with you itemizing your deductions. Do you see the standard deductions over here? See, if you're single or married filing separate, you automatically get $12,550. You automatically get that. So if your itemized deductions is not more than $12,550 here, it's not going to help you. It's not going to help you at all, because you're going to use the one that's bigger, because the one that's bigger is going to reduce your what? Taxable income. It's not going to help you. Again, guys, you got any questions, just let me know. All right. Married filing jointly. If you're a married couple, you got $25,100. Head of household, you got $18,800. So your itemized deductions, stuff like your interest on your home, your real estate taxes, your contributions to a nonprofit, all of those things must total up to be more than this. Let's take a married couple, $25,000. You have a house, you're paying a house, you're looking at interest. The first thing you need to look at is how much interest are you paying during the year on your house? Well, if a lot of people refinance and they're paying lower interest, 2%, 3%, because they refinance when the rates were lower, right? So if you're done that means you're paying less in interest. That's a good thing wealth-wise, because you're paying off your debt, more is going towards your principal. I get it, right? That's great. However, there's less interest going on, so it may not add up to be that $25,000. You got to take that, and then you got to add that to like your contributions that you're giving to your nonprofit, church organization, things of that nature, and see how much of that is totaling up to get. We're not seeing what it on the 10% of people itemizing. Because the next biggest thing that people do when they focus on this itemized, deduction and standard deduction that I get is medical. I see it a lot. People say, oh, I got this in medical and that in medical. I got a lot in medical. Well, when you look at medical, there's a percentage, 7.5%, which is 10% right now, that basically of your income that you get to use. So if your income is $80,000, you need to have $8,000. You need to have $8,000 for it, even the amount of medical. If you don't have $8,000 in medical, it's not going to help you. You got all your receipts, you got all this, but you got $2,000 that you spent out of your pocket and out your medical. It's not even helping you at all. Okay. So if the medical is not helping you at all, the zero. If you got the house and got the interest is not helping you. Now all of your, your charitable contributions, I'm talking federal, not state. Okay. Federal, that's not helping you at all. Okay. There. But most individuals focuses on those things. They focus on those things and it's not helping you. You do want to focus on things that reduce your taxable income, but those are not things that's not helping you. Now, you do see a charitable contribution line right here if you take the standard deduction, because you're going to end up getting a $300 deductions if you do that. So you're going to get a little bit for charitable. But if you have 300, you get more. Guys, I had to ask a person that people that like talking stuff and accent, they're like, hey, should I give the $5,000, $10,000, $20,000 in additional charitable to pay less in taxes? $5,000 pay less in taxes, but you're not even itemizing, and it's not dollar for dollar. Okay, so focus on the right things as far as doing that. Your goal is to use things here to basically adjust your gross income. Okay, basically things to adjust your gross income. One of the biggest things as far as adjusting your gross income, guys, to have is businesses. It's how are you getting taxed. Let's start looking at, and we can do a call actually later on and stuff, about where you're earning the income for to get taxed less on, because that's what real wealth is all about, is getting taxed, on in your investments and the business and stuff, because you're paying less tax on those. So you want to start actually, doing things like that. I'm not against, like certain retirement actually things actually that you actually have, but one thing that you have to actually do also that people looking at and they focus on, they say, hey, I'm gonna help my tax bill overall by getting tax deferred items. Okay, my IRA, my 401k, I'm gonna put more into that because I see on my pay stub that a gross income, but I'm getting taxed less on that as taxable income. I get it, but you need to look long term as well. You need to look long term. Tax deferred means I'm putting off what I pay on tax on it right now, and I pay it later when I take it out. We are at the lowest tax rate that we ever have been. We're the lowest tax rate that we ever have been. And if we're at the lowest tax rate that we ever have been, that means taxes will again go up. And if taxes are going to go up, do you want to pay taxes now when it's less? Or do you want to pay taxes when it's higher? One of the biggest mistakes that's going on right now, the biggest mistakes are going on right now. You want to pay taxes on things later. So you need to actually start talking to the financial person actually that you actually have and start talking about, hey, how can I take some of this tax deferred items and make that what's called tax free items? Because you want to pay on it later when it's tax free. You may pay taxes on it now, but if the law is at 10% right now, guys, that's what you want to do. We know that taxes are going to go up in 2025. That's what we know. May go up a little bit more than that, like early for most people. For some people, they will see an increase actually coming on that's making the income high enough. They will see the people going on, okay? But for most individuals, you would not see that much actually going on. But you need to actually focus on, like making sure that your taxable income is down. The next thing you want to focus on, guys, to really actually help you, that people don't focus on enough on is credits. If you qualify for some, there's a certain types of credits that you have. It's not on this. It's another actual page to have to show you because the forms are new now. But some people qualify for things. If you heard of child tax credit, if you heard of education credits and things of that nature, okay. Some are refundable, some are non-refundable. But you want to, some you have the dependents and things of that nature. Your dependents and stuff are credits that you get. Credits basically pay the bill for you. Credits pay the bill for you. Okay. Credits pay the bill for you. I'm going to say it again. It pays the bill for you. Okay. right? So if you have your tax bill, just like if you had that power bill, if you had that power bill there, and if Duke Power gave you a $500 credit and your bill was $800, you now only have to pay $3. That's what credits do. It just doesn't reduce your bill; it pays that bill for you. Okay, in doing so. So you want to look at different types of credit. So anytime thing that you read that says, "Oh, you may qualify for credit for," you want to really look at those things because that's dollar for dollar payment as far as doing it. Okay, all right. So those are some things. Okay, we do have actually a question out here about your brother Tate, and let's pop it up. He says, even something as simple as a network marketing business can help with shifting portions of everyday life expenses. Cell phone, exactly, and that's one of the actually big things that people do not know. Do you know? Average, company, network marketing, MLM, the multi-level marketing, whatever you want to call it, affiliate marketing, small businesses. Okay, if you had those things, guys, done properly, I want to say that, guys, done properly, that means you have the intent to generate a profit, you actively participate, and you keep your proper records. Okay, if you are able to do those three things with the business or networking, whatever you're doing, intent to generate a profit, participate, in records, do not get any company, network marketing company, other company, without the intent to generate a profit. You don't get those companies for tax deductions. You get those companies to make money, and then you get these deductions. That's a little bit different. But the average savings on companies like that is $300 to $600 easily in tax savings per month. Yeah, $300 to $600 easily per month if done correctly. Okay, if done correctly, stop kidding. Why? Because that strategy that our brother Tate just mentioned is simply turning your personal expenses that you're already paying now into business deductions. It's turning personal expenses. Your cell phone is a personal expense. Your internet is a personal expense. Your gas on your vehicle, personal expense. The maintenance on your vehicle, personal expense. The miles on it, personal expense. Your vacation, personal expense. Even portions of your house can be actually written off. Okay, those are personal expense. But one of the biggest things that we teach any business owner, anybody that has a one-person LLC, sole proprietor action business, one of the biggest thing that people are missing tax-wise, especially if they qualify for, is hiring their kids. Is hiring the kids. You can hire your child in between, and if they're in between the age of 7 and 17, okay, they are exempt from federal state taxes up to $12,400, okay, and we have $12,550 coming up, okay, that they're exempt from, and they do not have to pay Social Security and Medicare, but you get the tax write-off, and they don't have to file taxes. It's one of the biggest tax strategies that's out there that's being implemented. When you look at the IRS tax code, and when you look at shifting your income or tax shifting your income, right? Income shifting, basically, you will see way back all about hiring your kids. Shifting basically your income that you're making now that's at a higher tax rate, shifting that income to a lower income rate, which is your child, and paying less on it. Here with those strategies there that we mentioned, you talk about whatever your tax rate is, 15%, 22% and up, can be reduced down to zero, at least those $12,550 I'm talking about, down to zero. Which better is zero. It's all about actually reducing that. So actually, great actually question on actually doing that, guys. Okay. All right. So we want to make sure, guys, that you go into the new year, that you're going to number one, take advantage of some of the things that you had, previous years, some things that you can recapture to make sure that you're actually doing, right, actually from now to the end of the year and doing, especially if you have a business, you want to talk to your tax professional, you have a business. Now, if not, 2022 is coming. The time to start saving money on your taxes, okay? I could have had a fourth thing here about, what people are actually doing wrong is they don't plan. In 2021, starting in January, you need to start planning then to pay less on your taxes. You need to start planning then, guys, to pay less on your taxes. So structure yourself in different things to reduce your taxable income and pay less. Because again, one of those things that we need to actually put on there for us for is the wrong things that people are doing is they do not plan, they do not start in January. January is when you start saving money on your taxes for of 2022. You want to start January and continue to go on to save as much as you can. All right, guys. I don't see any more actual questions actually coming in. Don't see the more questions actually coming in, guys. If you are listening to this on replay, go ahead and still put your comments and stuff actually in. We do actually follow the actually thread so that we can give you some information back actually for you. Okay, guys. So we can get some information out back for you guys. We will love to do that as well. Okay. This, guys, has been this month's December's Old Gold Table Talk. We look forward to actually coming to you again in the new year, where we're going to have a lot of different conversations to talk about, not just actually financials like we did the last 2 months, but all of the interests and the conversations that brothers want to talk about. Okay, guys, we will see you all around the table, and we'll talk about the Old Gold Table, guys. We see you later. Have a great year. Bye.